I have over $3,000 of my own money invested in Meta stock. While most people are panicking about the crash, I believe it's created a massive opportunity, and I'm going to show you why I think Meta stock could 4x from here. First, I'm going to show you why the stock is down 28% from its all-time high. This chart shows Meta's capital expenditures, basically the money they're investing in AI infrastructure, building data centers to power and improve their social media and advertising algorithms. The trend in Meta's investment spending is worrying investors. They've gone from spending $16 billion in 2021 to over $75 billion on capital expenditures in the last 12 months alone. Now, this isn't necessarily a problem as long as Meta can prove to the market that their AI investments are generating a positive return, but that's uncertain, and the market hates uncertainty. Investor fears have been made even worse by the way companies like Meta are financing these investments. Initially, the company was investing profits from their core business. Then they began taking on debt, and now after Alphabet's move to raise $80 billion from the public markets by selling more shares, diluting the existing shareholders, there are rumors that Meta is planning to raise money through the public markets as well, adding fuel to the fire of negative sentiment around the stock. But despite the overwhelmingly negative sentiment, I'm going to give you the 3 reasons why I'm bullish on Meta stock. The first reason why I'm actually bullish on Meta is the continued and increasing strength of their core advertising business. As you can see from this chart, Meta's quarterly revenue growth is actually accelerating, growing 33% year over year compared to the 5-year average of 16%. And this increase in growth can be directly attributed to the improvements in Meta's advertising business due to their AI investments. In their recent earnings call, management confirmed that Family of Apps ad revenue was $55 billion, up 33%, driven by higher ad impressions, up 19%, and higher average price per ad, up 12%. This confirms that Meta is able to show more ads to their users whilst maintaining strong engagement. And more importantly, the average price per ad placement on Meta's apps is increasing significantly. Management say Meta's revenue growth is driven by higher engagement and ad load optimizations, with ongoing improvements in ad performance measured by conversion and return on investment using AI. So Meta's management are telling investors that their AI investments are dramatically improving their core business, suggesting that fears around low returns on Meta's AI investments are overblown. The second reason why I'm bullish on Meta is the huge opportunity and new markets that their AI investments could unlock. Meta's management say the core strategic focus is personal superintelligence, building personal and business agents powered by Meta's own frontier models. Meta's focus on agents is based on their belief that agents are the new operating system layer, the successor to the smartphone, the feed, and the app model. Meta isn't a cloud provider, so it can't monetize AI the way Microsoft, Google, or Amazon do. Therefore, Meta needs a consumer-scale AI product that uses its 3.5 billion user distribution advantage, operating inside their Family of Apps ecosystem to increase user engagement, meaning they can show more ads to generate more revenue. If agents are able to drive substantial improvements in user engagement, the hundreds of billions of dollars in AI capex may well be worth it. Meta's chief AI officer, Alexander Wang, explicitly frames Meta's AI strategy as AI that knows you, your goals, your interests, and helps you with whatever you're focused on doing. As you can see from this chart of Meta's revenue segments, advertising is currently the entire business model, but AI agents could unlock completely new revenue streams, reducing Meta's reliance on advertisers. And the company is already testing AI subscription services. Naomi Gleit, the head of product at Meta, revealed the subscription testing in an Instagram video, announcing that the plans give people who use Meta AI more to work with, more capacity, bigger, more complex requests, and more room to create for businesses and creators. Meta One Plus will cost $7.99 a month, and the Meta One Premium plan will cost $19.99 a month. The more expensive version offers users additional computing capacity to produce more comprehensive responses and other advanced features, while the company will continue to provide a free version of the app. Some research firms are projecting the market for AI agents will grow to $24.5 billion by 2030, with an annual growth rate of 46%. If Meta can gain a sizable slice of that market, it will unlock a new high-growth revenue stream that could potentially outgrow their existing advertising business. The third reason why I'm so bullish on Meta is their current valuation. The stock trades at a 20 PE ratio based on their last 12 months earnings, and an 18 PE based on their earnings expectations for the next 12 months. And if we compare Meta's PE ratio with the rest of big tech, you can see that Meta, represented by the blue bar, trades at a lower valuation than Alphabet, Amazon, Microsoft, and Nvidia. But if we compare those same big tech companies by revenue growth, you can also see that Meta is growing faster than Alphabet, Amazon, and Microsoft, despite trading at a lower valuation. Meta's valuation is definitely influenced by their reliance on the advertising business. Whereas a company like Alphabet is more diversified across advertising, gaming, subscriptions, and cloud services. But as soon as Meta proves to the market that their AI investments are paying off, I'd expect their PE multiple to increase. There have been periods where Meta stock traded at even lower multiples than they do today. For example, between 2021 and 2022, the stock declined 77% from its all-time high. The sell-off was caused by similar factors to the recent decline, including a heavy investment cycle that the market deemed unpredictable. But since the bottom of the 2022 sell-off, Meta stock is up roughly 350%. Next, I'm going to run you through my base, bear, and bull case assumptions for Meta stock. Using Qualtrim's DCF calculator, we can project the expected return from Meta stock over the next 5 years. First, we have my base case assumptions, which include 18% earnings per share growth over the next 5 years and a 25 PE multiple. An 18% growth rate is quite conservative in my view. Over the past 5 years, the company grew EPS at an annual rate of 25%, and the 25 PE multiple is pretty reasonable for a company like Meta with impenetrable network effects. In this base case scenario, Meta stock would compound at an annual rate of 22%, increasing from $570 to just under $1,600 per share by 2031. That's nearly 3x upside. Then in my bear case scenario, I'm projecting annual EPS growth of 15% and a 20 PE multiple. Based on these bear case assumptions, Meta stock would increase at an annual rate of 14%, increasing from $570 to $1,100 per share. So even with what I'd consider bearish assumptions, Meta stock would almost double. Then for my bull case, I've gone with annual EPS growth of 21% and a 30 PE multiple. Meta stock has traded at a 30 PE multiple quite frequently over the past 5 years. So with these bullish assumptions, Meta stock would grow at an annual rate of 30% over the next 5 years, increasing from $570 to over $2,100 per share. That's roughly 4x upside from today's price. Now I'm going to tell you what I'm doing with my own $3,000 Meta position. Despite the massive potential upside from today's price, Meta's already a large position in my portfolio. I think it makes up around 12 to 15% as things stand. So even though the opportunity to buy more is very appealing, I'll be maintaining my current position until I have more cash available. Are you buying Meta at these levels, or is their AI spending still too risky? Let me know your thoughts in the comments. And while you're down there, subscribe to the channel for more investing deep dives.